In this particular context, let us deal more on the basics and essential knowledge that every Forex trader needs to have. We'll deal on key concepts and terminologies and what they mean. Now, in the previous session, we already talked about what Forex is, how it is the business of foreign exchange, buying and selling of currencies to make profits, and how it is traded in pairs, so you'll be able to exchange one currency for another. And we also made mention of brokers, how they connect us to the Forex market. So basically, a broker is a company that gives you access to the Forex market through a trading platform. We talked about the MetaTrader 4 and you needing a broker to trade. Now, how can you get access to a broker? It is simple for you to get access to a broker. All you have to do is to go to the broker's website, complete your KYC. That means your registration and you know your customer details. You will be required to upload an ID card and proof of address, something like that, depends on your region. And you will be able to access the broker service, deposit money, and trade there. So if you want to use the broker I use, you can check the link in this video description and you will see my link tree there. You will see access to all the brokers and every relevant link I wish to share. If you also wish to participate in conversation about Forex trading, you will also see a Telegram group attached. We'll also host live sessions. Now, let us talk about some key trading conditions that brokers set. These are some ways brokers make money and some basic concepts as well you need to know as a beginner Forex trader. Now, the first thing I want to talk about is spread. So what is spread? So the spread is the difference between the price you buy, which is also known as the ask price, and the price you sell, which is also known as the bid price. So the difference between the ask price, that means the buying price, and the selling price. Let me show you an example. If you come to your MetaTrader, you will see that the buying price and the selling price, there are always differences between these prices. So for example, if I click on this currency right now and then click on statistics, you will see the bid, which is here. This is the bid and this is the ask. So once again, the bid is the price you sell if you wish to sell with this platform and this broker, and this is the ask if you wish to buy. And as you can see the two prices are not the same. There is a minor difference between the bid and the ask price. Now, the difference between this bid and the ask price is what we call the spread, and you'll be able to actually see this on the chart. So click on your chart, load it up. Fine. So if you click on your chart and load it up, you will notice these two lines. This is, if you wish to buy currently, this is the price they will sell it to you at. And if you wish to sell, this is the price you'll be able to sell from. So the difference between these two price levels here, these two prices, you can see the one in red and the one in green, those are the spread. So a practical example of what the spread is like maybe when you change money at Bureau de Change, they will sell it to you at a higher price than they got it for and buy it at a lower price so that they will make profit. So for example, if you have $1,000 and you go to the Nigeria Bureau de Change, maybe a local one, that you want to change money, they might negotiate to buy it from you 1,400 per dollar. But if you want to buy from them, that is you selling to them now, but if you want to buy from them, they might tell you 1,600 per dollar. So that is the summary of spread. Now the next thing I want to talk about is commission, also known as trading fees. So some brokers will charge a small fee per trade in addition to the spreads. So for example, if you try to do transaction via a bank, they might charge you a transfer fee for sending money. If you're in Nigeria currently, you notice that for any transaction above 10,000 naira, they will charge you 50 naira for receiving that transaction. So that specific type of charges in brokers are called commissions. So they are charged in addition to spreads. Then another form of charges you see in brokers, this one is called swap. Now, the swap is also known as overnight charge. This is a fee or interest that is applied when you leave your position to run overnight. So it's like borrowing money from a lender and then they give you the deadline that you have to refund the money today or you pay 1% interest. So it is typically that kind of same scenario. So if you hold your position overnight, then you will have to pay an interest. They will charge you an interest for keeping that loan longer than the time, for holding your position over the night. The forex markets will actually charge you for that. It could be positive swap, it could be negative swap. So you might be paid swap or you might be charged swap. So but the swap is a fee that is applied to trades that are left to run overnight. The next thing we want to talk about is leverage. The summary of leverage is borrowed money. And who offer you this borrowed money? Brokers. So leverage will allow you to be able to trade with more money than you have in your account. A broker lends you the money to increase your buying and selling power. So leverage is just like the same thing. You have 50,000 naira to start a business, but then you decide to take 500,000 naira extra loan because you already have experience. So you having your small capital and using it as collateral, and borrowing that extra capital, that will allow you to do your business in a larger scale, incur more losses if it goes negative, or make bigger profits if it goes positive. So that basically is leverage. Now, the entry for trading forex is very expensive, and this is why leverage is important, especially if you don't have a big portfolio. So for example, come to think of it, let me give you a summary rundown. So in forex, positions are measured in standard lots, which I'll still touch on in this particular context. One standard lot, for you to buy a standard lot of position in forex, it costs $100,000. So come to think about it, just for you to trade a standard lot, you need $100,000. Now, most people who wish to get into forex, they don't come into forex with this type of money, and think of spending this whole money in just buying a single standard lot. So this is where broker comes in. Broker will give you leverage, which is borrowed money. It could be times 1,000. Now, if a broker offers you times 1,000, that means they borrow you times 1,000 of your money. How much do you think it will cost you to buy a standard lot, which is 100,000? It will now cost you just $100 to buy a standard lot. So this, you brought just $100, then the broker multiplied it by 100 for you by virtue of the leverage, and now you have a buying power of $100,000. So you'll be able to execute positions worth $100,000. So leverage actually help us to be able to make money with small capital in the forex market. Now, the next thing we want to talk about is margin. Now, what is margin? Margin is the minimum money needed to trade. So in the previous illustration, where we wanted to trade one lot, and we illustrated that what we needed was $100, because the broker will borrow us times 1,000, which is leverage. Now, this 100, which is the money that is required to trade the one lot, because the broker will borrow us times 1,000, is the margin. So in the previous illustration, the $100 there is the margin. So the margin is the money you must have in your account to be able to open this specific trade of the specific size you wish to trade. Now, there is something called margin requirements. So yes, it is for the brokers to protect their money as well, because they are borrowing you a lot of money. So if, for example, you are holding a standard lot, which is equivalent of $100,000. Now, this standard lot, you have times 1,000 leverage, for example. The broker might ask you to hold a margin requirement of 50%. So that means if you get into this position of one lot size, you get into this position which is equivalent of $100,000, the broker does not want to see you have a drawdown of minus 50% if you have just that specific required margin in your account. So if you have $100 in your account, the broker does not want to see you go down minus 50%. That means minus $50 holding that position. And their stop out requirements, which is a requirement for protection purposes to the traders, will trigger and they will close you out of the position because you incurred 50% loss of the required margin that was needed to hold the specific position you were holding. So understand this. So if you're in a trade and you see that sometimes the broker just stop you out and you've not lost your own money, just understand that is margin requirements coming into play. And the next thing we want to talk about, Forex market hours and trading sessions. So basically the Forex market operates 24 hours a day, but 5 days a week. So the Forex market does not open during the weekend. So the Forex market does not open during the weekend. It only opens during the weekdays. Now, one of the most volatile time, one of the time you see the most activity trading Forex is during the London and the New York session. So basically, there are 3 major sessions. For some people, they classify it as 4. But the Tokyo session and the Sydney session can easily be classified as 1, as the Asia session. And then we have the London session and the New York session. So in summary, if we want to consider them from context of major sessions, we have the Asia session, the London session, and the New York session. So that is the basics for the trading hours when the Forex market operates. So take note, it is 24 hours a day, but 5 days a week. All right, this time, let us dive into currency pairs again. Now, Forex trading involves trading currency pairs. Each pair consists of a base currency and a quote currency. Base currency, so for example, if we're trading the euro versus dollar, so this is a currency pair. Now, this first currency in the context is called the base currency. And the second currency is called the quote currency. Fine. So this is the base currency, this is the quote currency. When you have a currency pair like this, if you expect the pair to gain value, it simply means you are expecting euro to gain value over USD. But if you anticipate that this pair will lose value, it simply means you anticipate USD to gain value over the euro. So this is currency pair and the relationship between base and quote currency. Now, this is based on quote currencies. There are still more about the currency pairs. For example, types of currencies. Now, there are different types of currencies. There are major pairs, there are minor pairs, and there are exotic pairs. The major pairs, they always include USD, the US dollar. For example, of major pairs, you have Euro, USD, you have GBP, USD, you have USD card, and so on. But the summary is the major pairs, they always contain USD, be it on the quote side or on the base side. So this USD is quote currency here, but USD card, you can see USD is base currency there. Now, those are for major currencies. Then we have minor currencies. So minor currencies, they involve major strong currencies, but USD not involved. So for example, we have Euro, GBP, which is an example of a minor currency. Then AUD and ZD is also an example of a minor currency. Finally, we have exotic pairs. Exotic pairs contain one major currency and one currency from an emerging market. So for example, it could be USD as a major currency, and then you have the South African ZAR as a currency from an emerging market. So this is a major currency, and this from an emerging market. So these pairs are called the exotic pairs. Now, when you're dealing with exotic pairs, they are typically very expensive in terms of spreads and charges that the broker will charge you. Then the pairs that are cheap to trade, the cheapest pairs to trade are the major pairs. So the cheapest pair and the most liquid pair, that means the most traded pair, is this pair here, Euro USD. So this is the cheapest pair to trade. It has the lowest spread. And the lowest commissions overall, and it is the most traded pair in Forex. So that's about currencies and currency pairs. All right, let us talk about other trading related concept. Now let us talk about pips. Now, what is a pip? A pip is the unit of measurement of price in Forex. So it is usually measured something like this. So let's say we have a currency pair 1.0. Let's check an example from our MetaTrader. If I click on Euro USD, for example, and then click on details. Now, these details, you see the measurement is in 5 digits. But take note, pips is in 4 digits. Pips is 4 digits. So pips is 4 digits. Now, once the digits are 5, that means there is more than pip in that particular measurement. So 1, 2, 3, 4, 5. So if you have something like this fourth digit after the decimal is 1 pip. Now, this one after 1 pip is less than a complete unit. So this is something that is less than 1. So that is something like 0. So if you take out the whole context here, this 5 here simply means 5 points. So 5 points, a point is 1/10 of a pip. So for you to get 1 pip, you first get 10 points. So 10 points fit into 1 pip. So the final decimal here in our trading platform, they measured 5 units. They measured 5 figures after the decimal. So take note, this last figure is a point and not up to a pip. So a pip is always the fourth figure in major currencies, or currencies that are measured, currency that have decimals in the first place. So currency that have decimals in the first place, the pip is always the fourth digit after the decimal. So in this particular context, 4 is 1 pip, 3 is tens, 2 is in hundreds, and 1 is in thousand. Let's go again. That means we have 1.1, 2, 3, 4, 5. So 5 is less than 1. 5 is less than 1. So this is 1 pip. This is in points. And 10 points makes 1 pip. So this second figure is 1 pip. Any increment here means 1 pip. So for example, if this figure in your trading platform moved from 4 to 5, that means the market has increased with 1 pip. If this one moved from 5 to 6, that means the market has increased with 1 point. Now, if these 3 move, that means the market has increased in 10 pips. If this one move, that is in 100. If this one move, that is in 1,000. So for example, if these digits like this changes, let's say we have 1.12. What does this mean? Change it from 1.12345. Fine. So what has changed here simply means this, guys, will cancel this. And what is left is, so what is left is 345 minus 455, and that will give us difference of 110. Now this 110, take note, we factored in the last figure, which is points, and 10 points make 1 pip. So in this context, if we calculate the whole price measurement like this and it involves points, then you divide your answer by 10, and then it will give you the answer in pips, which is 11.0. So for simplification of calculation, when you're striking out, if you don't want to involve the points because it is a very small increment, especially when you're trading small positions, you can just strike out the points and just 34, just find the difference between 34 and 45. Just find the difference between the reasonable increments excluding the points difference, just for simplification of calculation or to do a quick calculation. So that is on calculating your pips. Now the calculation for some currency pairs are different. For example, the one for USD JPY is different because the decimal there is in the third place. So for example, USD JPY, you might have it something like this, blah blah blah. So the decimal will be in the third place. Let's say for example like this, 3 digits here. So you have your decimal at the third figure. Now let me leave this as a task for you guys to go and discover how to calculate it, and you can come back to write how to calculate it in the comment section here. But the logic is very similar, but I just want to leave that to you guys as task. Now the next method of measurement in Forex is lot sizes. So lot size is simply the amount of currency you want to trade. So the lot size is the standard unit of measurement of Forex trading volume. Standard unit of measurement in Forex trading volume. So for example, if you want to buy petrol, they measure to you in liters. But in Forex, if you want to buy foreign exchange or sell, they measure it in lot size. These lot sizes, there is a standard for the units of measurement. The minimum you can trade across most brokers is 0.01. Now this 0.01 contains 1,000 units of currency. So 1,000 units of currency with just 0.01 lot size. And this measurement, anything within the increment of 0.01 to 0.09 is called the micro lot. So they are called the micro lots, and they contain thousands of units. So from 1,000 units, so 0.01 is 1,000 units, and to 0.09, which is 9,000 units. So these are under the category of micro lots. Now after micro lots, the next category we have mini lots. And mini lot is equivalent of 10,000 units of currencies, and the measurement for it is 0.1. So anything within 0.1 to 0.9 fall under the category of mini lots. And after mini lots, we have that of standard lots. Standard lots. A standard lot is anything a complete figure 1.0. This is a standard lot, and standard lot contains 100,000 units of currencies. 100,000 units of currencies. So let me show you where to find this in your MetaTrader. With MetaTrader 5, it is similar thing with your MetaTrader 4. So when you click on any currency you want to trade, so let's say this example Euro USD, and then you see this option pop up, trade. Click on it, and then this point here is the lot size. So this is the volume to buy or sell. I'm in a demo account, so I can practically show it right now. So if I impute this like this is a standard lot. That means 1.0 or anything above 1.0. Then if I do this is a mini lot 0.1. This is a mini lot 0.5, 0.9. Even this is a mini lot as well because it is less than 1.0. And then this is a micro lot this is a micro lot, this is a micro lot, this is a micro lot, because it is less than 0.1. And this 0.01 contains 1000 units. So this is where it all makes sense. Think of it that you want to execute this trade and you need $1000. So most people will not have enough liquidity to be able to execute reasonable trades that will actually yield them profit. So that is why broker come in, they borrow you multiplication of your money in terms of leverage, so that you'll be able to make money from the small increments of price in the forex market. So basically, these are some of the major things you have to understand as you are taking interest and getting into this forex space. For you to be able to trade, for you to understand what is going on here, you need to understand this basic knowledge. If you feel like you have questions or anything that confused you from this section, feel free to ask a question in the comment section, and also check the link, also check the description attached to this video. You will find any relevant link you need as resource for this video.